Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Friday everybody. Weekend is almost upon us. I hope you all have a restful weekend ahead. We begin today's episode with the Chinese economy. And first up, yesterday, Thursday, the People's Bank of China, China's central bank, released its Q2 monetary policy report. Analysts were quick to point out the appearance of new language in the central bank document, including resolutely prevent the risk of exchange rate overshooting, promote the financing of enterprises and the cost of household credit to be stable and declining, timely adjust and optimize real estate policies, and play a positive role in promoting consumption, stabilizing investment, and expanding domestic demand. Interestingly, the report did not include the once popular but now not so much line, houses are for living in and not for speculation. The central government also committed to better leverage the dual functions of aggregate and structural monetary policy tools and firmly support the recovery and development of the real economy. Putting all this bureaucratic speak aside, the report makes it obvious that senior policymakers have 3 primary concerns, 2 of which are systemic, housing and debt, and the third is related to the Chinese currency. Analysts with Chinese financial media outlet Cailian write today that in terms of real estate, the report mentions changes in supply and demand and the current weak performance of real estate in this regard. So it is expected that subsequent support for stabilizing the property market will moderately increase. And some of the support is already being rolled out. In the Q2 report, the People's Bank of China said it will extend until May 2024 a special loan program designed to support embattled real estate developers in completing stalled projects as the country's property market crisis drags on. The special lending program was launched in November of last year. We covered it at the time, and it was designed to provide 200 billion yuan, $28 billion of new loans at nearly zero costs for commercial banks to lend to cash-strapped developers that missed delivery schedules for residential projects. Chinese financial media outlet Caixin, writing on this specific announcement, reports that as of the end of June, 500 million yuan remained in the special loan quota balance, adding, quote, China's property industry showed no sign of recovery as key business indicators slipped further in July, stifling the recovery of the world's second-largest economy, end quote. We remember that according to official numbers published this week, property investment in July dropped 28.7% month-on-month. Property sales by floor area slid 6.5% year-on-year during the first 7 months, compared with a 5.3% decline in the first 6 months. First and secondary home prices also declined for the second consecutive month in July. The total area of new housing construction fell 24.5% year-on-year during the January through July period. Meanwhile, the People's Bank of China quarterly monetary report also discussed China's currency, vowing to prevent excessive currency movements as the yuan continues to slide versus the US dollar. The central bank said it will resolutely prevent over-adjustment in the yuan, which it said has yet to deviate from its fundamentals, adding that it has, quote, policy tools to safeguard a stable foreign exchange market, end quote. Then today, Friday, Beijing delivered its strongest ever pushback against the weak yuan via its daily reference rate for the managed currency. The People's Bank of China set its so-called fixing at 7.2006 per dollar compared to an average estimate of 7.3047 in a Bloomberg survey with traders and analysts. Bloomberg reports that this was the largest gap to estimates since the poll was initiated in 2018, observing that the central bank, quote, appears to be seeking to restore confidence to the market spooked by disappointing data and heightened credit risks, end quote. The outlet adds that authorities, quote, have been escalating their support for the embattled yuan over the past week, only to see it sinking in both onshore and overseas markets toward multi-year lows, end quote. Multiple outlets are also reporting, citing unnamed sources, that this week Chinese authorities told state-owned banks to step up intervention in the currency. For example, Hong Kong-based South China Morning Post writes today that senior officials are considering the use of tools such as cutting banks' foreign exchange reserve requirements to prevent a rapid depreciation of the currency. The request came as the yuan fell towards 7.35 per dollar. Quote, a level that top leadership have been paying close attention to. End quote. US outlet Bloomberg writes that authorities were also, quote, checking whether domestic companies helped accelerate yuan declines by conducting speculative trades against it. End quote. And UK-based Reuters writes that China's major state-owned banks were seen busy selling US dollars to buy yuan in both onshore and offshore spot foreign exchange markets this week, quote, in an attempt to slow the yuan's depreciation, end quote. While we are still on the economy, a new round of research notes from banks and other analysts indicate that global investors are once again dumping Chinese securities. UK-based The Financial Times writes today that portfolio managers and analysts said selling, which appeared to slow following a Politburo meeting last month, had gained pace in August and was likely to accelerate in the wake of a surprise cut to the benchmark interest rate this week, which we covered on China Update a few days ago. The reversal of flows into Chinese securities, the outlet observes, quote, reflects crumbling confidence in promises made late last month by party leaders who pledged to boost weak consumer spending, tackle high youth unemployment, and provide more support to the country's troubled property sector. End quote. The head of Asia Trading Strategy at Citigroup, in a note published yesterday for clients, claims, quote, the measures taken so far appear to have disappointed the market. There is increasing frustration and concern from investors about the lack of any solid policy action, end quote. These views appear widespread and increasingly entrenched. In Bank of America's latest Asia Fund Management Survey from last week, 84% of respondents said they believe Chinese equities were in the middle of a structural derating. Next up, Xi Jinping returns, and a veteran China analyst asks if China is facing a financial crisis. Hey everyone, if you enjoyed today's episode of China Update, don't forget to hit that like button. If you want to see more of this sort of content, 50% of regular viewers are not subscribed. Subscribe and hit that bell notification. This is the best way to actually be shown the videos when they're released, and sharing this with someone who you think would enjoy this sort of content or get value from it is one of the best ways to help the channel grow. And for anyone who can go the extra mile, Patreon and Buy Me a Coffee links are in the description below. It is just me making these 6 days a week. It's a lot of work, but your support makes it all worth it. So thank you, everybody, for the ongoing support. Yesterday, we discussed how Premier Li Qiang returned from the annual Beidaihe leadership meeting to head the second plenary session of the State Council on Wednesday. The following day, Thursday, yesterday, General Secretary Xi Jinping reappeared too in order to chair a Politburo Standing Committee meeting. We just need to note the salient details of this development and then move on. The focus of the ruling Politburo Standing Committee meeting was to, quote, study and arrange work on flood prevention and relief, as well as post-disaster restoration and reconstruction, end quote. The meeting stressed, quote, all-out emergency rescue and relief efforts to help the trapped and search for the missing to minimize casualties, and efforts to reinforce dams that are crucial or relatively weak and meet the basic living needs of flood-hit residents, end quote. Northern China, of course, has seen massive flooding over the last few weeks, first triggered when Typhoon Doksuri hit the country, resulting in Beijing seeing its heaviest rainfall in 140 years. Extensive damage has been done to parts of the north of the country, with Fitch ratings warning that damage to rice yields could put further pressure on global rice prices, already at a 12-year high. On this theme, in late July, an audit report by the Henan provincial government documented how about 10 billion yuan, $1.4 billion of funds earmarked for the 2021 summer flooding in the province, quote, had been misused or siphoned off for other uses by local officials, end quote. The story quickly went viral online before being censored. And finally for today, I wanted to end by unpacking observations made by a veteran China analyst and commentator, someone who we have quoted many times on China Update, Bill Bishop has been writing on China's political system, culture and economy for decades. Indeed, Bishop's experience in China goes all the way back to 1989, where he observed in person the whirlwind events in the weeks leading up to the crackdown at Tiananmen Square. In an informal commentary published today, Bishop, who has lived through several false alarms over the Chinese economy in the past, asks the question, is this time different? We will end by looking at some of these comments, which I am now quoting directly. The financial events of the past few weeks demonstrate that the tough battle against financial risks, one of Xi's three key tough battles, along with poverty alleviation and pollution after the 19th Party Congress, has not yet achieved victory. What if Xi has decided they just need to chew on the hard bones? Bishop is employing a Chinese expression here, and do a much bigger restructuring, and so therefore will tolerate the risks of a financial crisis. They seem stuck as the incremental efforts over the years to deal with the massive buildup of debt have not solved the problem. There are plenty of people who have been saying for a long time that the Chinese economy would eventually crash due to the weight of massive debt, and certainly over the last few days and weeks these voices have become louder and somewhat triumphant. In previous periods where a crisis looked like it was imminent, we saw similar surges of "it's finally happening," only to see the leadership muddle through to avoid a crisis. Will this time be different? It is harder to see anything but a very painful push forward, and given Xi Jinping's history of decision-making, and especially the example of the exit from dynamic zero COVID, I don't think we can rule out the possibility that he could decide it is much better to just let things rip and do a reset. But neither can we rule out the possibility of a sudden pivot to once again step in forcefully, a pivot which would be painful for anyone to bearish. Perhaps the leadership's public confidence that things are not that bad is justified. But in June 2013, as the interbank market started blowing up, they seemed surprised. And in 2015, they fumbled the RMB devaluation in a way that made them look incompetent. Has the economic policy-making process improved since 2015? Or might they quickly realize things may be worse than they thought and shift to a much more proactive response? Apologies, the above is a bit of a ramble. I am just struggling to get my head around why they appear to be marching towards the brink of another financial crisis. Maybe they have a plan, but they have not yet articulated it well, and the events of the past few weeks strengthen the arguments of those who say the PRC is increasingly uninvestable. Here ends the direct quote. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a wonderful Friday, and I will see you all tomorrow.